It was a tall order for the Philippines to show that it has what it takes to swing reforms and deliver the aces. In a region where economies compete for attention, it has never been less than tough. Growth in Asia is set to continue with growing investment opportunities, regulatory reforms, and strength of technology and consumer sectors. Investors have watched the Philippines seriously and critically. 2005 was a year of intense anticipation. 2006 is a year of revelation. The trends, themes, and stories that dominate the Philippine economic landscape reveal a country that has done its homework. Clearly, the Philippines makes things happen. Mabuhay! I am Ida Marie Miranda and welcome to another edition of Philippines in Focus. Today we'll be talking about the state of the Philippine economy and exactly how the country is currently making things happen. The VAT reform law is now in place to reinforce fiscal and macroeconomic stability. This important fiscal reform is complemented with tax administration and collection efficiency measures to raise revenues for infrastructure and social priorities. A debt consolidation program is being pursued to reduce the country's dependence on foreign borrowings. Monetary policy has kept its focus on putting inflation under control to support economic growth. Bank regulations and local banking practices are being aligned with international standards and practices. The development and commercialization of alternative forms of energy are taking shape to raise energy self-sufficiency. The operation of the wholesale electricity spot market, the first in Asia, commences to ensure adequate electricity supply at competitive prices. The country is getting much boost in the credibility scale just by having these reforms done. The fact that these reforms are taking root and producing targeted results is indeed capturing investors' attention. There is much evidence of improvement. The domestic economy sustained strong growth in 2 consecutive quarters in 2006, delivering a solid 5.5% rise in the second quarter. Agriculture and manufacturing showed remarkable upturns, while the finance subsector propped up services. 3 fiscal surpluses in the months of April, May, and June 2006 showed a combined surplus of 26.1 billion pesos. This brought the national government deficit down to 49 billion in the first 7 months of this year, well within the 125 billion full-year target. Revenues have risen by 21% year-on-year and spending by 10%. Debt ratios have improved. As of end March 2006, national government debt to GDP ratio dropped to 71%, from 78% in the previous year. Similarly, external debt to GDP ratio declined to 54% as of the end of the first quarter of this year, from 62% during the same period in 2005. Balance of payments in the first quarter of 2006 yielded a surplus of $2.1 billion on strong inflows from OFW remittances, exports, and direct investments. This boosted gross international reserves to an all-time high of $21.3 billion as of end July 2006. Price pressures have eased. Inflation in the first 7 months of 2006 averaged 7%, well within the forecast range. Asset quality of banks, as indicated by the industry's non-performing loans ratio, has improved significantly to 8.2%, from a high of 16.9% 5 years ago as bad asset cleanup progresses. Bank capitalization has strengthened considerably from implementation of risk-based CAR framework in 2001, going up from 15.6% in 2001 to 17.6% as of September 2005. Energy self-sufficiency has steadily improved from 45% 5 years ago to 53% in 2005. Investors are increasingly convinced. Investor confidence resurges. Investors reward the Philippines for making things happen. Republic of the Philippines bonds are one of the best performing in Asia and among emerging markets. ROPs maturing in 10 and 24 years tightened by an average of 165 basis points in 2005 and by around 65 basis points by end of August this year. Standard & Poor's, Fitch, Japan's R&I, and Japan Credit Rating Agency have all changed their sovereign outlook from negative to stable. Investment banks such as Merrill Lynch, ING Bank, JP Morgan, Nomura, Credit Suisse, and Goldman Sachs have kept their overweight recommendations on sovereign debt. Multilateral institutions have commended the country's economic reform successes and expressed support for more lending to development initiatives. Investment inflows have accelerated. Net foreign direct investment grew 53% in the first 5 months of 2006, reaching $743 million. Mining, business process outsourcing, and IT sectors continue to be the favored spots. Financial market is on a roll. The peso appreciated against the US dollar by 3.8% in the first 8 months of 2006. Demand for local equities and government securities remained strong. During the 8-month period, the Philippine Stock Exchange Composite Index rose by 10.3%, making it one of the best performers in the region. 91-day Treasury bill rates averaged 5.4%, lower than the 7 to 8% annual forecast. Out of these rewards comes a picture of the Philippines constantly reminding itself that it cannot be complacent. Much remains to be done. External risks of global oil price volatility and world economic slowdown are among the significant challenges the country will face going forward. 3 R's dominate the next wave of policy agenda. First, reducing the cost of doing business. Much has been said about the growth potential of the country's deficient infrastructure. The infrastructure investment program in the next 3 years will lower the cost of doing business, boost productivity, and ultimately raise competitiveness and growth in the long run. Second, reinforcing revenue generation. Legislative passage of the rationalization of fiscal incentives, restructuring of the income tax system, and fiscal responsibility bill will be pushed. Tax administration will be further improved through the BIR and BOC revenue enhancement action plans. Governance and anti-corruption measures will be relentlessly pursued. These measures are aimed at achieving the government's fiscal consolidation goals over the medium term. Third, reducing the economy's vulnerability to external shocks or uncertainty. The economic momentum will be broadened with more growth-enhancing and job-creating investments and a better financial infrastructure. What does this agenda mean for the country? A lot of groundwork has been done. 2006 is setting the stage of years of good trends. Indeed, the prospects for increased fiscal and macroeconomic sustainability are getting clearer. Mabuhay! This has been Ida Marie Miranda encouraging you to keep your focus on the Philippines, because the Philippines makes things happen.